Hey everyone, welcome back. So today I just want to share some S&P 500 statistics with you, the earnings reports that are coming this week to keep a lookout for, and then just 3 news articles that I found interesting that could help you research in the 2026 year, depending on what you want to be invested in. So we see here that the S&P 500 has a tracker, but it's JP Morgan, of all the sectors and which ones perform best, how much they performed in comparison to the S&P 500. We see here that communication services outperform the S&P, which is the fourth column, by nearly double, which is absolutely crazy. So you see that the communication services did 33% returns last year for one full year to date. And then we see technology did 24. So about 10 points better did communication services do. Then we see industrials, and then we see the S&P 500 comparison, and you see all the other ones do less than the S&P. So these less than the S&P are going to be more fairly less risky in the sense of your losses if there's a downturn. We see real estate did the absolute worst at 3.2% gains. And there could be reasons why these are lower this year. You know, there's a lot of volatility, especially energy in the oil industry, and what we're going to do. Are we going to do clean energy? We're going to go back to coal, so people are hesitant. Then we see real estate doing abysmally compared to communication services. But if you want to be in a less risky ETF, then you could choose real estate if you're closer to retirement because there's less risk. Now we have the earnings reports. Let's go to Monday. We're going to see a ton of banks on this list. It's banks weeks. So we see here that Barnes and Nobles. So if you're into books, and by the way, Barnes and Nobles, I believe they said they want to open up dozens of new stores, which is interesting because people are moving more to AI and to technology that they can read books on. So the fact that they're opening up hard stores is very interesting. So keep a look out for these if these are in your ETFs, and enjoy the Monday report. Tuesday, we'll start to see a ton of banks. We see JP Morgan, we see the Bank of New York, and then we have all these other companies that are having their earnings reports on Tuesday. On Wednesday, we see Bank of America, Citigroup, Wells Fargo. You see basically a ton of banks on this list. New Horizon Aircraft. So if you're into travel, take a look at some of these earnings reports on Wednesday. On Thursday, we see Goldman Sachs, of course, more banks, Morgan Stanley. We see BlackRock, major investing company. Taiwan Semiconductors, that's going to be a huge one if you're an SMH. That's a semiconductor ETF. It's been performing extremely well for the past 5 years. So take a look at this one, and it's SMH as the ETF. This is going to be a big one for people who are in QQQ and the technology because this could have a major impact, and they've been doing really well, so there may be a pullback if the earnings reports is not as good as people expect. And we see more banks. Then on Friday, of course, we just see more banks. So it's a big week for banks. If you're invested heavily into banks, then this week is going to be either really nice for you or you're going to lose all your money. So keep a lookout for these earning reports. And then I just want to go through 3 quick articles. I'm not going to go through them. I'm just going to kind of explain them. So small caps could outperform the S&P. Small caps have not outperformed the S&P in like 15 years. They've always performed about 8%. And the S&P's perform more closer to 12 to 15. But the reason why small caps are expected to go up is because we are lowering rates this year. We know that Powell's out. We know that rate cuts are going to happen this year. So given that, small caps tend to perform better because they can borrow more at a less rate, meaning companies don't want to take risks. They can now borrow money without fear that they'll go bankrupt if they cannot meet the demands of their payments that they owe. And I'll just show you real quick. Sorry for the ad there. See, there's a 15-year historical anomaly where small caps have not been outperforming the S&P. The S&P typically rises 17%, while the Russell, which tracks small caps, is 12. Then I want to show you the ticker. It's IWM. If you're interested in small caps, that'll track the Russell. So you'll be able to invest in 1,962 small caps. And basically, you're going to be in almost 2,000 small caps. So we see here that the average annual rate of return is 8%, and which is the 15-year era of large caps outperforming. So very interesting. And the management fee is very small. Typically, I mean, there's some smaller ones, but 0.1 is not bad. So you'll keep more of your money. Now we have a article about how the S&P is expected to rally 12% this year. Again, this is expected based off of the GDP revenue that's going to happen this year. Expected because the AI boom is still happening. The article also does go into the fact that we may be in an AI bubble. Of course, the article always does that. They always say, "Oh, all this," and then they go into, "But maybe it might not do what we say," just so they can say that they didn't predict it or get people into trouble. Um, so a 12% gain this year, as of January 6th, is actually less than 18% and 25% from 2024. Interesting, 2025 was 18%, 2024 was 25%. Those are huge gains, but still 12% gains it's free money. So if you're in the S&P, you're going to gain 12% of what money you put in. And you can read this article yourself. And then global stocks and emerging stocks are expected to do well. 7.7% is kind of low because it did about 25 to 35% this year or 2025. But if it's we're going to return an annual 7.7, that's actually really good because if that's paired with a high growth fund that you have like QQQ, and if it's paired with like a VTI at 12%, and if it's paired with a dividend fund, so now you have four funds. Let's say you have a growth stock, you have a dividend stock, you have a total stock market index, and you have this. Typically, the people's fourth choices are going to be smaller than 7.7. So a 7.7% return is actually going to be very good, especially if you want to hedge your risk with your growth fund. I would take a look at some emerging stocks. I know VWO is one, and you could choose any. Take a look at how they perform. So that's it for today. I just want to do something different. Have a fantastic week.